Welcome back. Take a look at futures this morning. We've got a firmer tone and a nice rally in the NASDAQ. Dow Industrial's up 32. The NASDAQ up 175 this morning. We are about 6 minutes away from the jobs numbers for the month of January. Economists are expecting the 180,000 non-farm payrolls to be added to the economy in the month of January, with the unemployment rate ticking up to 3.8%. We'll get those numbers shortly. It could be a market mover. Joining us right now is Zip Recruiter chief economist Julia Pollack, Heritage Foundation economist, and former Trump economic advisor Steve Moore, Macro Mavens president Stephanie Pomboy, and also with us is Charles Payne, Rebecca Walser, and Cheryl Casoni. Great to see everybody this morning. Thank you so much for being here. Stephanie, let me kick things off with you. Get your take on what you're expecting from jobs, and what are you going to be focused on when we get these numbers in about 5 minutes' time?
Well, what I'm really going to be looking at is not so much the January jobs number, but the benchmark revisions to the payroll data for last year. As we've been talking about every month, there's been a huge gap between the household survey and the payroll survey, and maybe that will be rectified with these benchmark revisions. The household survey shows about 800,000 fewer jobs created in 2023 than the payroll survey. The other thing is payroll tax receipts are down 2% year on year, while the payroll employment report shows an increase of 2% year on year. So these numbers don't add up. So I'm looking at those benchmark revisions. As to what January is, this number is so unpredictable because every January the economy sheds 3.2 million workers. So for the BLS to estimate to the nearest 1,000 how many jobs were actually created in the month after seasonal adjustment is kind of a challenge.
But do you still expect the economy to slow, and do you still expect jobs to start reflecting that this year?
I do, and hopefully the shenanigans with the payroll report fall away and we actually get some real numbers. But the broad trend is clearly slowing. And then obviously you look at all the regional ISM indices, the NFIB, all the real-time indicators of employment suggest we're going to see that continue, to say nothing of the prospect that we have a double-dip profits recession, which I anticipate this year, and obviously that will immediately impact hiring plans, which we did see with the Challenger survey, with hiring plans just absolutely imploding.
Yeah, Julia, what are you seeing from your end?
Yes, we're also seeing job gains slow and narrow. So I will be focused on the breadth of job gains. Which industries are really causing jobs in America at the moment? This clearly is a time where Fed Chair Powell does not seem to be very worried about the labor market, but almost everyone who has a front row seat and is watching this labor market closely is a lot more nervous and says that the labor market hasn't just slowed to pre-pandemic normal, but has actually slowed further.
Yeah, I want to get your more on what you just said, that you think the jobs market is narrowing. That's a really important point. But first, Steve Moore, weigh in here. What will you be focused on when these numbers come out now in 2.5 minutes?
Well, Stephanie really nailed it, that we've never seen this before in the last 25 years, where you've seen such a divergence between what the payroll survey is telling us and what the employer survey is telling us in terms of how many jobs are out there. So, as you know, there's been a big reduction in the number in the in the survey that is done of people who are taking the survey themselves. Here's the thing. The other big thing that's happening in the employment situation right now, we've talked about this week after week, month after month, is the biggest employer in the last 6 months, Maria, has been what? Government and healthcare. If we get jobs, we want to see those jobs in the industries that actually make things: manufacturing, construction, wholesale, mining, business services. That's where we want the jobs, Maria. Yeah. Not in more. No, we should be shrinking government jobs now. My God, we're running $1.5 trillion deficit. Why do they keep spending so much money?
Well, I mean, one of the areas that we've seen lots of job creation has been healthcare. Rebecca, I know this is one of your favorite sectors in terms of buying those stocks, but this is a big field.
Yes, absolutely, Maria. And I want to pick up on Stephanie's point because I agree that the numbers don't add up. And specifically, the last time we saw such the amount of revisions that we've seen was 2008. So it almost is eerily similar to what is happening. Labor is a precursor. And so I'm really looking for the revision of what happened last month. And again, to put a spin on, the fact that we have consistent revisions to the downside. The average last year was 47,000 jobs. It's not a small number, Maria.
Yeah. In terms of healthcare, do you like healthcare stocks?
Well, I like healthcare because they have a gene splicing technology that is really stimulating a lot of pharma to go a lot of new product. It's kind of their AI frontier. So, yes.
I see. All right. We are just about getting these numbers shortly. We're waiting on the jobs numbers where we're expecting 180,000 jobs created in the month of January and the unemployment rate to tick higher to 3.8%. We are watching the revisions, of course, and we're also looking at production. You got the numbers?
Wow.
All right. Let's get right to Cheryl.
And
Go ahead,
this is something. 353,000 non-farm jobs. I had to seriously double check this, guys. The unemployment rate went down to 3.7%. That's the actual number. We were looking for 3.8%. Let me give you I don't even know what to say here, but all right, let's go through this. All right, private sector jobs, 317,000. The street was looking for 155. Government jobs, 36,000. We don't get an estimate on government jobs, but remember last month it was 52,000. Average hourly earnings year over year up 4.5%, and that's more than what we were expecting. We were looking for 4.1%, and then 0.6% is the month to month, and that's also higher than expected. We were looking for a jump of 0.3% on average hourly earnings, and we came in with a jump of 0.6%. A few other things. The labor force participation rate, 62.5%. That's exactly what we had last month. But again, it's the headline. It's the headline numbers here, guys. The fact that you got 353,000 jobs. Thank you, Maria. All right, I'm going to dig into the report here and kind of see where the hiring was, because I have a feeling I know what it's going to say, but let's give you the actual, what the government tells us. Professional and business services saw a gain. Healthcare, retail trade, social assistance. Employment fell in mining, quarrying, oil and gas extraction. That's where we saw the breakdown. So that's the headline numbers, guys. And the market, Maria, was up. We were up as we were going into this, and we are now down.
Well, the Dow Industrials are down, but the Nasdaq's up 109 right now. But certainly the Dow has reversed course in the face of this. I'm wondering if it's the strength of the jobs numbers or also the wage number here. Stephanie Pomboy, your reaction to this report?
Well, I think you're right to key off the wage number, Maria, because this idea that the Fed is going to pivot and cut rates in March seemed insane on its face before we got this number. I was struck that in addition to not asking the Fed about why they removed the statement about a sound and resilient banking system from their statement, no reporter asked the Fed if everything's so great and the Atlanta Fed is forecasting 4.2% GDP this quarter, why on earth is the Fed contemplating rate cuts at all, much less people, talking about potentially in March? So I think this wage number kind of amplifies that. I would say about this 353 headline number, just underscores the point I made about the wild seasonal adjustments for the month of January. Again, when we flip the calendar from December to January, the economy loses 3.2 million jobs as all those holiday workers disappear. And the ability of the BLS to measure that with any, fine point is ridiculous. And I think this number will be revised lower. But again, no one will pay attention to that other than us here on Fox Business.
You ready for the revisions?
Yes.
This is going to get everybody's attention for December. They revised December to 333,000. The initial number we got for December was 216,000. That's the revision for the month of December. That's just incredible. I don't even know what to say about these revisions.
I think the revisions, but more importantly, the wage number is really something that this market is focused on. But Charles Payne, weigh in here. Your thoughts?
We go back to that sort of Powell presser, and you always wonder what he knows and what he sees has access to before ahead of time. Obviously this is the reason we're giving a lot of equity gains up is because now this sort of takes the Fed out of play. And I think Wall Street has more confidence in the Fed being accommodative than the fact that we may have a strong economy. If you had to have either one, I think ideally you want a strong economy to be the sort of buttress for a strong stock market. But I don't know that there's a lot of confidence in that. And the Street would have rather seen a lower number, infuse the idea that maybe March is still in play, despite what Powell said. And it's one of these things that you got to comb through. I'm always focused on how many people came into the labor force. I see the participation hasn't changed, so it's going to be some interesting details to go through.
Well, we want to go through those details right now. Julia, what strikes you here?
Well, it looks like the labor market is accelerating, not cooling, and that is inconsistent with a whole lot of other economic data that we've received recently. The JOLTS report showed a big decline in job openings over the year. It showed a big drop in hiring in the last 2 months of the year. This is really remarkable, a big surprise to markets and to economists who are following the labor market.
The next question is, what does the Fed do about it, Stephanie?
Yeah, well, again, I think that it's insane that they're even contemplating rate cuts in the face of this data. I would point out, though, the household survey was down again in this number. After being down 687,000 in December, it declined 31,000 this month. So not as dramatically, but still, you have a yawning gap between what the payroll survey is saying, what the household survey is saying. So maybe that's something that the Fed is focused on, and maybe that's why they're kind of tilting dovish. But this report, I think, really blows a hole through this idea that they're going to pivot anytime soon, to say nothing of, the math on inflation, which the CPI numbers will hit their low in February, and then they start to skew higher year on year after that. So the Fed has a very narrow window, if it's going to cut rates, before the inflation data start to act as a headwind.
Steve Moore, look at what Treasury yields are doing right now. We've gone from down to up on the 10-year, and we're talking about a pretty big move on the heels of these numbers. Assess the report.
This is
10-year
so
up
amazing.
9 basis points right now, Steve. Steve, the 10-year's up 9 basis points. The 2 years up 11.5 basis points.
So this is at least the third or fourth or fifth month where we've seen this huge discrepancy between what the payroll survey is telling us and the household survey is telling us. That if those numbers are right, that we're talking about almost 400,000 discrepancy between these two, and that's been going on for a long time. I don't understand that. I don't understand how you can continue to have one report saying it's a good employment situation and another report saying that it's not a very good one. The other thing that I would add to this is, there is no reason right now the Fed should be lowering rates. If you look at, we talk about the economy doing well, but the other point is, look at what's happening to, for example, commodity prices over just since the beginning of December. Commodity prices are up 7%. And that's a lead indicator that we have not solved the inflation problem. So I think it would be a big mistake right now for the Fed to be lowering rates.
Yeah. Well, look, he took it off the table in March. If he doesn't do it in June, it's going to be all political, and people are going to say he's getting political. That's, of course, what President Trump told me in my exclusive interview, that he thinks the Fed is going to get political and cut rates to help Joe Biden. Rebecca, how do you see this report?
It's a shock, actually. And, Maria, it doesn't jive. The Challenger report just said that U.S. employers announced 82,000 job cuts in the month of January. So where are all these jobs coming from? Obviously, need to look at the details, but it does not compute. They do not add up. And I think that, you've got UPS saying 12,000, Citi saying 20,000. Yeah. We're getting these consistently big announcements of massive layoffs, and yet we come with a job report that's like the best jobs report we've seen in 6 months. Yeah. What is happening with the BLS data? What is happening?
When you look at ZipRecruiter, Julia, and you see the number of applicants looking for work, where do you see the most demand? Where are the asks?
So we're seeing a huge pickup in job seeker activity. The labor force has grown very quickly over the past year, mostly because of women coming into the labor force in larger numbers than was expected, and also because of immigration. Immigration has been very strong the last few months.
When you say immigration, what do you mean?
So, I mean, I'm just looking at visa immigration. So employment eligible immigration has been very, very high. The administration made up for backlogs during the pandemic and for embassy closures by streamlining processes and getting rid of those backlogs. And so actually more visas have been granted to immigrants per month than is normal.
Cheryl, what really strikes you about this report? You talked about the revisions and, of course, the wage number. But what do you think the Fed's focused on?
Well, I mean, obviously, Jay Powell talked about this when he did the press conference on Wednesday. I mean, he was celebrating the jobs data. Maybe now we know why. But I mean, look, they basically, the problem is when you've got somebody that's got monetary policy and the employment picture on their radar, which obviously is the Fed, this does not make the case for a rate cut even in June. I know we discussed the flip side of that argument, which is if it's a political decision, then maybe June is going to happen. But if it's based on the data, I don't think he has the argument to cut rates when it comes to June. I will also tell you that now, the Fed funds futures, after this report have crossed, there's less of a bet now that you're going to get any rate cuts between now and the summer. Look, the Fed has got a dual mandate. We understand that. At the same time, I don't believe these numbers. And because I have covered revision after revision every month last year. We had massive revisions. They also revised March of last year in this report, guys. You can't figure out the data from March of 2023.
Yeah.
So I just don't believe these numbers.
One thing that is interesting, though, because we always kind of focus on hourly wage, but average weekly hours came down a lot. So as a consequence. So as a consequence, average weekly earnings actually declined in January from December. That's really amazing because a lot of economists that come on the show say, well, it's okay that we have record amounts of credit card debt at record yield, record interest rates because people are working. But if you're working fewer hours, granted you had a raise, but if you work fewer hours, in this case, in December, the average weekly earnings were $1,178.55. Last month, it was $1,178.16. So you are taking home a smaller paycheck. So that's something intriguing to keep an eye on.
Even though the wage number in this report was a lot higher.
Even with the higher wage number, you're still taking home a smaller paycheck than you did in December.
Yeah, I mean, Stephanie, in terms of what happens next, how surprised are you that we have not seen a bigger impact from 11 rate hikes from the Federal Reserve in terms of slowing this economy down? And by the way, I think January is usually funky. I mean, because you're coming off of the holidays in December. Managers are figuring out their workforce for the year. So I'm not sure about these January numbers and whether or not we're going to get a big revision next month.
Yeah, again, the seasonal adjustment factor is huge in this number, so that's a factor. The other thing that they do with this payroll number that's different from the household number is they have this birth-death imputation that is an attempt to figure out how many net new businesses were created that haven't yet been captured in the payroll survey. And that's generally the source of all the monkey business, let's put it that way, that explains the difference between household and payroll. But I think that, the broader question here is, what does the Fed do with this number? Obviously, they can't dismiss the stronger headline payrolls, even though we're all highly suspicious about the quality of it. And as to your question about, the impact of the interest rates and why they haven't been felt yet, I would argue they have been felt. It's just that the markets have been blissfully ignoring it, in part because of numbers like we see this morning. But the fact is that corporate bankruptcies were the highest in 2023 since the global financial crisis, other than during the COVID lockdown, and the default rate is moving up. Corporate credit downgrades were the largest again since the global financial crisis. So I think what's happened is that the credit markets have absorbed that on the hope that we're going to get a pivot, and therefore the increase in rates would purely be a temporary inconvenience that would quickly be resolved by Fed rate cuts, in which case, hey, all you have to do is get from here to there. And if that gets challenged by a delayed pivot, things could get really ugly because we have an enormous amount of debt.
Yep.
We have an enormous amount of debt that rolls this year.
Yeah,
so
exactly.
Let me add to
you
that,
know what?
though.
Stephanie made the right point. They're not focused on a slowing economy and these bankruptcies. They're focused on AI, Charles.
Yeah, without a doubt. But why all these rate hikes didn't have the same impact? 89, there's a great piece from Apollo, 89% of U.S. debt at a fixed rate. So, and this also explains the dilemma within the housing market. No one wants to sell their home. But, when you have 71% of housing debt at a fixed rate, then higher interest rates don't matter to you. When a large portion of student loans, auto loans are at a fixed rate, then it doesn't matter. So these rate hikes hadn't hit people the way they had in the past, particularly in the 70s, in the 80s. So it's an intriguing thing, but there's a different sort of buffer right now. But it's caused other problems in the economy, obviously, like the housing market situation.
Yeah, Cheryl, let's reiterate. Okay, you had 353,000 jobs created in the month of January, and the unemployment rate is at 3.7%. Cheryl, what else strikes you about this report?
Well, I think what strikes me is something that Stephanie was bringing up, and obviously this is not to believe this report, and we kind of knew this going in because the Labor Department, look, they do the seasonal adjustment factors. It is they update their population estimates for the household survey. So I think what Stephanie kind of mentioned, and I'm going to reiterate, I'm waiting for February. I think that's going to be a clear picture of the employment. The other issue, and something that Charles brought up earlier, that we talked about, ADP. We saw IT job losses, and so we know that companies.
You mentioned that when it happened. You were surprised.
I was like, okay, IT jobs. But then you also had a guest on yesterday in the 6 a.m. hour that said the same thing. We're seeing layoffs in IT. We're not seeing that in this report. But am I going to see that in February? I have a feeling I am.
Rebecca, what's important to you?
I mean, I just can't reconcile the data being and the revision to the upside from December, a so positive revision to the upside, which negates the 50,000 job revision that we had to the downside in November and October from last month. So this is and how is the ADP report such an outlier to this number as well this week? I mean, it is just not reconcilable. And someone who likes data and to make prognostications around data, this is again very difficult to really understand what's going on here. But I think all bets are off. I totally agree with Stephanie. I never understood, and obviously Governor Christopher Waller said this last month, that this is not the data on which we make cuts. And you got another banner beat on this job report for January. So, I think the market is going to have to really tap down expectations on rate cuts and stop getting ahead of the Fed.
Steve Moore, what do you want to say?
A couple things. One is that the point that Charles was making earlier about people working less hours, that's a really important point because, one of the conundrums about this economy right now, Maria, and you cover this almost every day, why is it that all these government surveys are showing the economy getting better, but if you look at polls of the American people, 2/3 say things are going in the wrong direction, and nobody can quite figure that out. And I think one of the reasons for that is people are still financially stressed out from the 18% increase in prices from the day Joe Biden came into office.
Yeah.
And yes, wages and salaries may be up in percentage terms, but as Charles just said, if you're working fewer hours, your paycheck is not keeping pace with the amount of things that people cost. The other thing I just want to say, this is completely, I want to remind people that the January number is seasonally adjusted. So this is a seasonally adjusted number, and January is always a month where, fewer people in retail because the Christmas season is over. So I think on balance, the economy is doing fine right now. There's no question about that. But people aren't feeling the love because they're still financially stressed out. I mean, when you've got, yes, the inflation rate is coming down, but let's not forget that 18% increase in prices is baked into the cake. In other words, people feel every time they go to the grocery store.
Yeah, it's a great point. And I want to get your take on the uncertainty of all of this, Charles, because we're talking about a situation that is real fluid. President Trump told me last night that he expects a potential for massive inflation again with a spike in oil, largely because of what's happening in the Red Sea and the hostilities in the Middle East. If you're talking about these shippers being forced to change change their route, have a longer route, that's going to cost more money with more, obviously, oil, gasoline. That's going to spike that area of inflation, and it may very well create a bigger issue for inflation after having come down from the highs. So I think that's something that Jay Powell is looking at for sure, and I'm certainly focused on it as well. Your thoughts?
Yeah, you have to. I mean, some of these shipping rates have already gone up 4 times.
200% is the last number I looked at. The shipping rates were up over the last 6 months.
The routes, right? But some of these routes to Europe have really skyrocketed. Yeah. China a little bit less now. Ours are going up. We know they're going to go up more. We have a little bit of lag, but I think if you remember, like 6 months ago. It's so interesting because the economists seem to have this group think, no offense to any economists on the panel, and it's like whatever is happening at that time. Remember when the bounce in inflation
was the big thing? We got only economists. What are you doing? We're all economists.
Like 6-7 months ago, every economist, well, you know what, there's going to be a bounce in inflation. So that was the narrative. Actually, everyone believed it less than a year ago, and then the narrative became, higher for longer than it was ever. So it's always some kind of catchy thing you can almost put on a bumper sticker. But you've got to be aware of this, and you have to be concerned about it because, that goods part of the inflation puzzle is probably going to spike. How much, we're not sure, but it will spike.
Yeah. Cheryl, more info in terms of what you're looking at next week.
Real quick, I just want to add professional and business services, 74,000 jobs, guys. I'm sorry, another question mark coming from me here. The average increase is 14,000 a month, but now all of a sudden 74,000. I just
in professional and business services.
I just don't buy that. But anyway,
retail trade up 45,000. That's sometimes temporary, but these are full-time jobs.
No, these are full-time jobs. I think look, what do we do with this data? I think at this point nothing. I think we wait until next month. But I will say this: as far as the economy and the jobs picture, look, I mean, I think that. We still have a very healthy job market. We expected this report to show a cooling job market. And if we don't get that, that is your rate cut story. Unfortunately, that's not going to happen. The other issue, I think, for the markets really is what we've been talking about, Maria, that's tech.
Yeah.
We've had all these reports coming out this week from tech. So the market can, you can drive up those tech stocks and keep your NASDAQ strong. But, I think we're going to have a kind of a rough month of February.
Having said that, the headlines look good. The jobs created 353,000 jobs in the month of January. I don't know. I see a Biden press conference happening later today.
Oh, yeah,
so he pushes Bidenomics. But Julia, I want to get your take on those job seekers out there. I spoke with somebody the other day. They said to me, Maria, you don't know how hard it is right now to get a job. And I'm thinking, wow, the numbers have been really strong. What are you talking about? Tell me about that. People out there who are looking to switch jobs, get a new job. What are the opportunities right now, Julia?
Well, we have seen job seeker confidence tick upwards slightly in the last 2 quarters. Our newest survey that just launched today of Q4 new hires showed that they were still very satisfied with their new jobs, that 70% got a pay increase when they switched jobs, that many of them got signing bonuses, but few of them are getting actively recruited by employers. And I think what we're finding in our data, the sort of mixed data, underscores what we see today. The 2 big surprises to me in this jobs report are what happened to the full year job gain number for 2023. We thought that was 2.7 million before this report. This report revised it upward to 3.1 million, although in the household report, the year-over-year gain was only 1.9 million. And then I think what Charles said about the hours number is a really serious one. So many people are finding jobs, but they're not finding the hours that they want. And the hours number in this report is actually quite startling. So in good economic times, the work week ranges between 34.3 hours and 34.6 hours. It's a very sort of predictable range. This report has an hours number I haven't seen in years, 34.1. Very, very, very low. And that number captures demand for labor quite closely, and it tracks what we're seeing in online job postings.
So you're saying people are deciding to work fewer hours. They're making that choice.
I don't think that this is a choice made by workers, actually. 60% of job seekers want more hours. And
employers aren't giving it to them.
Yes, hours track demand usually. When employers want workers, they get as many hours out of their workers as they can. They give them overtime. They give them mandatory overtime sometimes. We're not seeing that. Overtime hours are down, and overall hours are also down, and they're in sort of unhappy territory right now.
Yeah, I like that analysis a lot, Julia. Thank you for that. Stephanie, where do we go from here? Tell me what you're going to be focused on to get more information in terms of the economic path ahead.
Well, I think you raised the critical issue earlier, Maria, and that is, again, coming back to inflation and what we're seeing in terms of renewed supply chain issues and higher energy prices. You know, this is what caused the inflation surge with a healthy dollop of fiscal and monetary stimulus that, you know, allowed it to be accelerated through the entire price structure. But that all dissipated, and now it's starting up again. And I think what we've got to watch is what that means for corporate profit margins, again, as these input costs go up and they have a harder time actually dealing with these supply chain issues, in which case, again, I think you have the prospect of a double-dip profits recession, which will be negative for the outlook for employment. I might say, to Julia's point, one possible explanation for why we see these strong headline payroll numbers and yet a decline in the work week is this labor hoarding idea that, you know, after the pandemic, businesses had trouble getting workers. And now, rather than just rushing to chop heads, they're just cutting their hours instead because they don't want to let workers go if it turns out this is just a temporary soft patch. So it may be that. You know, time will show. But I'm really focused on the inflation pressures that you talked about, Maria, and the effect they have on corporate profits, and then obviously on the broad inflation numbers and the potential for this whole pivot nonsense to go right out the window.
So, Rebecca, what kind of a market performance are you expecting this year?
Well, actually, we're looking at the Dow, and I see it's down, but I'm actually interested in how this is impacting NASDAQ, especially because we had such a powerful pre-market, Maria, this morning. Because obviously, as Stephanie just mentioned, as you continue to have an inflationary type environment with this kind of headline number being added, it pushes the rates cuts off the table further back, and obviously that has a massive impact on tech stocks because they're longer duration stocks like bonds. And so as we see the yields go back up on the Treasury yields, I would expect that tech also is negatively impacted. And we've had such a strong tech start, especially because of AI. So really, I would expect that the tech is not going to like this number. And I'm also really interested to see, it's like people, we have this big headline number, Maria, but people are having to work. They are getting less hours. So are we having more multiple job holders?
Yes. Can I jump in? I'm sorry, guys. But no, it's exactly. We got that data yesterday. I just want to remind everybody, we got the first read on Q4 productivity and labor costs. Labor costs were only up 0.5%. We were looking for 1.6%. Okay, so they're paying people less.
Yeah.
And the productivity number jumped higher than expected, 3.2 versus the 2.5. So workers, they are more productive and they're making less money. And that was for the entire fourth quarter. I think that's more to come, guys.
Yeah. Steve Moore, what about that? Your analysis.
This is an important thing. I didn't see the numbers for this recent report because I haven't been able to look through the report, but I've looked through the last 3 or 4, and what you're seeing is that there's been a big leap. Remember, we talked about this last month of multiple job holders, people who have to work 2 or 3 jobs just to maintain their living standards. So that's a tough thing for people. And let me just say one other quick thing. Just is totally anecdotal. But I have 3 friends, that are in their 50s that have worked for companies for 15, 20, 25 years in some cases, Maria, and they got laid off. And these are people, in their mid-50s, and they're like, what am I going to do now? I've worked for this company for 25 years. I don't know if you're all seeing that, but this is a new phenomenon where people, once they reach their 50s, these layoffs are happening with that age group. And that's a sad thing. What do you do in that kind of situation? Maybe
Julia,
you're making $120,000 to get laid off.
Is that what you're saying, Julia?
So, I think what's tricky about the labor market is it's just such a complicated, heterogeneous market where you have so many nursing jobs, healthcare providers cannot find enough workers, and yet most of us can't go and become a physician tomorrow, right? So in tech, that sector lost lots of jobs over the last couple of months. In information, and we're seeing reporters being laid off all over the place. It's always difficult to figure out what the trend in layoffs is in January because we're, in December and January, that is layoff season in America. 20% of all layoffs take place in just those 2 months. So it feels
20% in between December and January?
Yes, this is the time when there are the most unemployed people per job opening. And it's very competitive for job seekers out there right now on ZipRecruiter.
Yeah.
Employers are getting lots of applications per posting, but it's going to get better for them over the next few months. That's what typically happens anyway. And so, hang in there. Things will hopefully turn around. But yes, it is a tricky market despite these great numbers. Even though jobs are being created, they are mostly concentrated in healthcare and government and leisure hospitality. Although job gains did broaden in this report in a way that I think surprises.
Yeah, were you surprised to see a decline in jobs in mining and lodging?
No, not really. That sector is pretty small and a little bit volatile.
Okay.
But I was very surprised by these huge numbers in business services. I mean, over the year, business support services have lost jobs, and so many.
Well,
related
we're at
fields.
the lows of the morning on stocks. Dow Industrials right now down 141. The Nasdaq has all but given up a huge rally in place earlier. The Nasdaq's up still about 60 points.